Hello, and welcome to our final review podcast for business organizations. Keep in mind that you already have a midterm review available to you on YouTube. That deals with all of the unincorporated associations. So, in preparing for the final exam, review that midterm review another time. Now, we also have this final review, which deals largely with corporations. So the midterm review is the unincorporated associations. This final review is largely about corporations. Please note that this is just an overview of our materials covered since the midterm. It's a general outline of business organization principles that we covered in the last half of the class. But because it is a review in an overview, it's not going to have the same detail as our class discussions. So make sure you go back to your class notes and you revisit our class slides and our other supplemental materials such as supplemental cases for further details or information. This is just to try to help you orient yourself on some of the key issues, but drill down deeper in preparation for the final exam. Also, keep in mind that this podcast is in lieu of our canceled class of November 13th, 2019. So this is a replacement for that session, and you will need to follow the instructions you will find in this video podcast in order to receive attendance credit for the November 13th class. All right, but watch this, and if you have questions, please feel free to come back to me and ask me, and I'll help to clarify before the final exam. Chapter 6 begins our discussion of business corporations, our first incorporated business entity. It is a creature of state statute, both in its formation and in compliance over time in its operation. It is a for-profit business enterprise. It is formed through the filing of articles or certificates of incorporation, sometimes referred to as corporate charter, with the Secretary of State's office in the state in which the corporation is being formed. It has separate legal identity. It is considered a person under the law for certain obligations, such as the ability to own property, sell property, pay taxes, sue, and be sued. But it does not have all the rights of a person. So as a legal fiction, a corporation is a person. It has legal personality, but not for all things. One of the key benefits of the business corporation is limited liability for its owners, who are the shareholders. However, the shareholders do not directly govern the corporation. That is done by a centralized management structure. The board of directors are the ones who set the overall strategy and operations of the corporation. And corporate officers in the C-suite, such as chief executive officers, chief financial officers, and chief technology officers, are those that carry out the day-to-day obligations to meet the objectives set out by the board of directors. Since corporations are creatures of statute, the governing law is the state where the corporation is formed. You're not limited in choosing where you may form your corporation. You can choose any U.S. state or even a non-U.S. jurisdiction. In order to have the corporation under the governing law of that state or country, you must maintain an office there and appoint a registered agent. The primary role of the registered agent is a place where people can provide service of process in case of a lawsuit. You have to look at the law of that state or country to make sure you meet the other statutory requirements in order to maintain your status as a corporation. The Model Business Corporation Act provides a sampling or a model that many states have followed, including Florida, about what the state statutory requirements should be for a corporation. Like any state, there are specific state distinctions, and I've given you Chapter 607 of Florida Title 36 as the basis for looking at some of those state distinctions between Florida law and the Model Business Corporation Act. but Florida has indeed modeled its law after that act. Delaware is often a very popular choice for incorporation because it is thought to have a state-of-the-art business-friendly corporate code and a robust body of common law relating to business entities. In addition, a lot of folks will choose Delaware as a place to create their corporation because they have the Delaware Court of Chancery, which has 220 years of legal precedent in business entity law. Delaware also has some other important features, such as it has no sales tax and it does not impose a state income tax on corporations that do not do business in Delaware. In an effort to emulate Delaware and reliably attract incorporation business, other jurisdictions have amended their corporate statutes or made changes to their laws on issues of taxation or regulatory regimes in order to try to attract corporations to incorporate there. An example is Nevada, which has amended its corporate code to align it with Delaware's corporate code. They're doing that also in an effort to eliminate state income tax on corporations in order to attract businesses to Nevada. So it's not uncommon for states to try to compete with each other to show they are the most pro-business in order to attract in order to attract businesses to come to the state and create a corporation. Realize that the corporate laws or corporate codes are very important because they state the mandatory rules that a company must follow in order to retain its corporate and limited liability status. Also, unlike some of the other business associations we talked about this semester, because of the statutory requirements, there may be less opportunities to customize or contract out of legal obligations in order for one to retain their corporate status. Aside from formation and compliance issues in operating the corporation, the choice of what state one incorporates in can also have an impact on how that law is applied to conflicts that may arise between corporate stakeholders, such as shareholders, officers, and directors. The internal affairs doctrine is based on the notion if there are conflicts between those internally within the corporation, the laws of the state of incorporation will apply to that dispute over that internal affair. Under the internal affairs doctrine, the law of the jurisdiction of incorporation governs a corporation's internal affairs. It is a form of conflict of law doctrine with a constitutional dimension. It's based on the idea that only one state should have the authority to regulate a corporation's internal affairs. So any matters that are peculiar to that particular corporation and its current officers, directors, and shareholders should be handled by the laws of the state of incorporation. The doctrine tries to avoid uncertainty and costs that could arise if a business entity is operating in multiple states and would be subject to different or possibly conflicting rules about their obligations. It also reflects a presumption that those who choose to form their entity in a particular state desire to have their legal relations governed by the laws of that state. In practical terms, the internal affairs doctrine means that disputes involving the relationship among corporate stakeholders tend to be governed by the law of the state of incorporation. Take a look back at our case Vantage Point, in which we had shareholders in California that were trying to apply California law based on a claim of public policy to matters that had been handled by a Delaware corporation. The determination there was that under the internal affairs doctrine, it was the state of incorporation that would guide the handling and resolution of that dispute between the corporate stakeholders. Another important area that we discussed as regards any kind of entity formation is the tax treatment that that entity will face. If you are a C corporation, which is sort of the standard corporation, there is no pass-through towards the individual tax return that you might see, for example, in a partnership or in a limited liability company. One of the claimed negatives of a C Corp is the concern about double taxation, which means that corporate profits are taxed twice, once at the entity level and once at the shareholder level. Because after the corporation has paid taxes on its income according to the established tax rates, the corporation may distribute earnings or profits or some portion of it to shareholders as dividends. and the money received by the shareholders, even if it's as little as $1, must be declared as income by the shareholder. Thus, you have taxation of the corporate entity as well as taxation at the shareholder level, which is viewed as this more negative double taxation of corporations. We'll see if the most recent tax changes will make that less onerous, but there still will be this double taxation portion to it. For the S corporation, though, that's much more similar, somewhat similar to the partnership, where you can, if you meet the listed requirements to be an S corporation, you can have pass-through taxation, which contrasts sharply with the default taxation regime for the C corporations. And so what happens with the subchapter C corporation, subchapter S corporation, is that, like the general limited partnerships or the limited liability companies, it's a pass-through of all income earned by the business to the owners, who pay tax at whatever the applicable rate is for them as individuals and not as a corporate entity. So unlike the C corporation, the S corporation does allow for a pass-through. The C corporation has the issue of double taxation. When we look at the corporation, we know that there are certain key pre-incorporation activities as well as key post-incorporation activities. And of course, at the heart of the formation of the corporation are the articles of incorporation. Tends to be a form that you fill out and you file with the Secretary of State's office. Tends to be relatively bare bones and not a lot of things that are demanded in it, but there are some important things that must be contained in it. One, of course, is your registered office. That's basically what is your address or your registered address within the state. And you must also have a registered agent for service of process in case the business entity is sued. Another important part of the Articles of Incorporation is a corporate purpose clause. It's not required in all states, but it is required in Florida. And the idea behind the corporate purpose clause is a statement that describes what business the corporation is going to conduct within the state. Most states allow corporations to use relatively broad corporate purpose clauses rather than setting forward some kind of narrow purpose. You generally will have a general clause that says that the corporation is allowed to engage in any activity or lawful activity under the state's laws, and therefore that allows the corporation not only to conduct business that it is undertaking at that point in time of formation, but as it grows and expands over time, there may be other things that it does based on its growth. So having a broad corporate purpose clause is very important. In the past, if you had a corporate purpose clause and you acted outside of the scope of that corporate purpose, then another party could claim under the ultra vires doctrine that you were acting beyond your powers as a corporation because you were exceeding the activities that were permitted under your corporate purpose clause. That was kind of an earlier view. And some try to use this as a way to invalidate the activities of a corporation. But the Model Business Corporation Act and Florida law follows this, reflects the modern approach that you really are limiting the ultra vires doctrine, this idea that we no longer want to allow people to easily invalidate corporate contracts or corporate acts by claiming that someone is acting outside of the corporate purpose, and therefore having a broad corporate purpose clause helps to avoid this problem. You'll also have in the Articles of Incorporation a description of the classes of stock that are going to be offered and the par value of the stock that we'll talk about a little later. And there may be other customized optional provisions depending on the state statute. We know that under the MBCA and under Florida law, the corporation begins upon the filing of the Articles of Incorporation with the Secretary of State's office. In some other states, it's required that you have the approval of the Secretary of State before the corporation begins, but that's not the Florida or the MBCA view, which is corporation begins upon filing. That's an important thing to keep in mind. And also the idea of avoiding buying any kind of corporate supplies like rubber stamps or stationery or other items with the name of the business on it until you've done your filing in case there's any problems with the filing, and to hopefully avoid wasting company resources by putting down a name that you find out perhaps later on that you can't use, or maybe having to refile under a new name. So just keep in mind that the Articles of Incorporation get things rolling, and it's important to wait till they're filed until you buy corporate supplies to avoid waste. We discussed in class the role of the promoter, the person who basically we might call them the founder of the corporation, who is involved in helping to form the corporation and maybe perhaps finding investors to help support it in its early stages. But if one is the promoter, the one who is helping to organize the corporation, we've talked about the fact that they are an agent for a non-existent principal. The corporation does not yet exist, so they are on the hook. They are personally liable. And the default rule is that they are liable also for pre-incorporation contracts. So we see the Ratner case as a good example of that, of an individual who was the promoter for Stereo Corner. And although later on he did file the paperwork for the corporation, he did enter into a credit card agreement with the bank that allowed him to charge back. And when the corporation went under, the court determined that he as an individual could be liable because some of the fraudulent charges had occurred and the credit card agreement had been signed prior to the creation of the corporation. The corporation provides for the liability shield. And so at the time he signed the credit card agreement, he was an agent for a non-existent principal. And so later on, when they were seeking to get back money from the corporation due to these fraudulent charges, the court said that the promoter was jointly and severally liable with the corporation because this was a pre-incorporation activity. If you are the promoter, can be on the hook. And you're not liable to third parties on the contract if it can be shown that that third party had noticed that you were signing on behalf of the corporation and the third party agreed to look solely to the planned corporation to perform the contract duties or to make the payments. And so the bank, although they may or may not have known he was signing on behalf of the corporation, they clearly did not agree to look solely to Stereo Corner for payment on those contract duties under the credit card agreement. The liability of the corporation, well, the corporation can be liable for these pre-incorporation contracts if the corporation formally adopts the promoter's contracts, and that might be something that would be done in the initial organizational meeting, or if the corporation ratifies the promoter's contracts, and they can ratify that by making it clear that they're willing to follow through on the pre-incorporation contracts, or if they continue to retain the benefits of pre-incorporation contracts, or through an assignment to or a novation by the corporation, basically saying that the corporation is going to substitute itself for performance under the agreement for the promoter under the pre-incorporation contracts. But liability issues are very important in this early stage. If you are the promoter, you do take on a lot of risk because you could potentially be liable. That's why sometimes, as we see in the Ratner case, even though a corporation was later formed, he was still responsible for the pre-incorporation contract. So take a look at Ratner. That's a good example of promoter liability. After one has filed the articles of incorporation, some of the key post-incorporation activities that we discussed in class, one of course is drafting the bylaws. You had a chance to take a look at bylaws in one of our skills assignments, which often sets out the processes by which things are done in the corporate entity as it governs itself, along with setting out things such as stocks, different kinds of stock classifications. It will also help to determine in the future notice that must be provided when annual meetings must be held. So it is really a key process document. You will address who's going to be on the board of directors. You'll identify your corporate officers, who's the chief executive officer, for example, who's the chief financial officer. You will convene your initial organizational meeting in which you will have a vote on the bylaws to determine what the bylaws will be. And you will have the primary role of the shareholders will be to elect the board and to approve if it's going to be an S corporation. If it's going to be an S corporation, it has to be approved by the shareholders. They'll also approve of the bylaws. And then you will have typically a corporate secretary who will prepare and retain meeting minutes. Every corporation is expected to have regular annual meetings along with other special meetings and activities that they might have. So the corporate secretary's job is to prepare and retain those meeting minutes, which will spell out whether or not things such as whether the bylaws have been approved, whether they've been modified. It will identify the various votes on proposals that may have come up in the meeting. It'll determine who's on the board of directors. So it's a very important role, being the corporation secretary, to maintain control over what has been approved in these meetings by both the board and the shareholders and retaining those meeting minutes, and then subsequently pulling this material together to help file the annual report. But that's some of the key pre and post incorporation activities in forming your corporation. In Chapter 7, we looked at how a corporation seeks to finance itself. So the two primary categories are equity capital, oftentimes referred to as securities, and debt capital. We know that with equity capital, you're generally talking about stock that's being sold to investors, and these investors are shareholders or owners of the corporation. And the stock is supposed to represent the residual value of the corporation, the nature and value of the assets that the corporation has, and it's governed by federal securities laws. However, when you have debt capital, you're financing primarily through loans, bonds, and other kinds of debt instruments. Those that are bondholders or lenders are not owners of the corporation, and they do not necessarily dilute the residual value or assets of the corporation. So debt capital, you're basically a lender, whereas in equity capital, you're an owner. And we also talked about retained earnings, this idea that the company's value really comes from the profits that are reinvested in the business for the sale of whether it's goods, real estate, or services, or whatever else that the company's business objectives are. But retained earnings are those profits that are reinvested back into the business, which helps to bolster, of course, the residual value of the corporation, and the stocks are supposed to represent the overall value of the corporation. Also, revisit your class notes on the classes and values for stocks. Those are spelled out in the Articles of Incorporation or the Charter, depending on the language used in the state. Under the Articles of Incorporation, you state the number of authorized shares, and in the articles you also describe any privileges, preferences, or restrictions that are imposed on any class of stock. If there is only one class of stock, that stock is usually referred to as the common stock of the corporation. Common stock is the stock of a corporation that does not have any special features or privileges, aside from that of ownership. Preferred stock generally has some privileges. Typically, there may be a liquidation preference, as well as a dividend preference for those that own preferred stock. If the corporation is going to issue more than one class of stock, the charter must state the number of authorized shares in each class and the rights and preferences of each class. Now, under the traditional view, your Articles of Incorporation had to provide a par value for the stock, and some state statutes may set the lowest par value that would be permitted under your Articles of Incorporation, and the par value, whatever you choose, may impact your statutory taxes and fees that are charged by the Secretary of State's office. But the par value is the nominal or face value of each share of stock. It is generally quite low, and the par value is the minimum amount for which a share of stock may be issued. If par value is required in your Articles of Incorporation, the statement in the articles describing the stock can be quite simple. The corporation, for example, has the authority to issue 20,000 shares of common stock with the par value of $1 per share. Go back to some of our earlier skills assignments where you saw extremely low par values, including those that were hundredths of and thousandths of a penny in value. Under the more modern MBCA view, there is no need to set the par value. Under this more modern approach, the notion is that the board of directors of the corporation can determine what the minimum price will be, what they deem to be appropriate, as long as the prices set are reasonable. We also previously discussed in class some of the distinctions between common and preferred stock, and noted that even the rights of shareholders within the same class of stock may have different rights and privileges. We talked about previously common stock not having any special features or privileges, but it does have full unlimited voting rights. Typically, it's one vote per share. It might include fractional shares like 1 3/4 votes, things of that nature. If you have common stock, you are basically last in line to receive any of the assets. If the corporation is dissolved, as a holder of common stock, you may, if it's permitted under the Articles of Incorporation, kind of have the right of first refusal to purchase any newly issued shares on a prorated basis, depending on what you already own. And typically you cannot convert common stock to preferred stock. You don't have any redemption or buyback rights in common stock. With preferred stock, it's really all about what is said in the Articles of Incorporation, as well as what might be negotiated by those who are infusing capital into the corporation. They might be allotted certain preferences, both as to dividends and to liquidation. They may have cumulative distributions, which means that over time they add up and the corporation will have to pay up over a certain period of time, or it might be non-cumulative, sort of a fiscal year by fiscal year distribution. They do, unlike common stockholders, they can have preferred shares converted typically to common shares of stock, and they do have redemption rights. Oftentimes, venture capitalists or institutional investors who may be investing millions can bargain for additional desired rights or protections, such as additional seats on the board of directors, or they can have a mandatory or optional redemption schedule where the corporation has to buy back their shares. And we can see in the TCV6 case a good example of where the court had to determine how much would be paid back to the preferred stockholders who were demanding a buyback, and they wanted to make certain that the corporation would remain viable so it could carry out its business operations, as well as not harm its obligations to other creditors in this buyback process. So take a look at TCV6, where the court talks about the legal standards for when a company has to buy back shares from preferred stockholders. We also discussed the changing view of what kind of value must be received in order for one to obtain shares. The traditional view is that you could only provide cash for shares of stock, but the modern view under the MBCA is that you receive any kind of valuable consideration in exchange for shares. So that moves beyond cash to include both tangible and intangible property. So maybe it's a real estate, a building, or it could be land, or it could be intangible properties like trademarks or patents or copyrights. It could be promissory notes. It could be a contract for services that have already been performed or that will be performed in the future, or it could even be other benefits that a corporation might desire, such as a release of a claim against a corporation. So we're no longer limited solely to cash for shares. It's basically valuable consideration for shares under the modern view. Aside from equity capital, debt capital may be very useful to a corporation in financing itself. In general, a corporation might have profits that are generated from its business activities. Those are called internally generated funds. And instead of paying out profits to shareholders in dividends from these internally generated funds, a corporation might keep or use these so-called retained earnings to fund current or future plans. And although it might seem strange that if they've got plenty of money, why would a corporation borrow? Or a corporation might take on a lot of debt despite having access to internally generated funds. And there may be a lot of reasons for this. Maybe the interest rate on the debt is so low that the money becomes cheap and is actually more valuable to the corporation in the long term, or they may take on debt because the market demand for the corporation's debt securities allow the corporation to borrow very large sums at a minimal cost. For example, for Microsoft, at one point in time in 2015, there was so much of a demand for their stocks that they took $10.8 billion out in debt equity, which is its biggest bond sale ever, to try to capitalize on investor demand for Microsoft's highly rated corporate debt security. So there may not be that you're always running out of money when you're seeking debt capital. It's just another way to try to infuse resources into the company, and oftentimes you can deduct the interest from your taxable income. The important thing to remember, though, of course, is that debt does not necessarily impact or dilute ownership of the business, those who own stocks. Debtors are not owners of the company, but they do retain a preference over the owners, over the shareholders. And when it comes time for any kind of priority, if the corporation is either dissolving or liquidating its assets, or perhaps even going bankrupt, they'll take priority over the shareholders.
There are really two kinds of debt capital. There's unsecured, those that are not backed up by corporate assets or collateral, like promissory notes or loan agreements or credit card financing. And then there's secured or debt capital that is supported by corporate assets like bonds, accounts receivable, inventory loans, and mortgage notes. Usually secured. If there's a bankruptcy, the secured creditors get paid off first before the unsecured creditors. So there is a preference for secured creditors over unsecured creditors, should there be a bankruptcy or other need for liquidation. But in general, the creditors come in line before the shareholders, who are typically last in line if there is a liquidation or dissolution event.
We also spent a great deal of time this semester looking at issues of corporate governance. Go back to your slides and take a look at the hierarchy of corporate control. Since corporations are creatures of statute, the Corporation Code of the State of Incorporation, of course, plays a primary role in determining corporate governance issues, followed by the Articles of Incorporation, which basically charter the corporation, the bylaws, which spell out important corporate processes. The board of directors are the ones who have the responsibility to manage the corporation, and they do so on behalf of the shareholders. So shareholders have indirect governance. They elect the board, but it's the board's responsibility to manage the affairs of the corporation. And they tend to set the overall strategy and direction of the corporation. Officers, those that are in the C-suite, like CEOs and CFOs and CTOs, their job is to carry out the day-to-day operations of the corporation and may be removed by the board of directors if they're not doing a good job. We see a little bit of that in the Klassen case. And then, of course, employees who work for the officers of the corporation are also involved in the day-to-day operations of the corporation. So take a look at some of those issues of corporate governance that we discussed, starting with statutory codes all the way down through employees. Keep in mind that although code is very important, we see that in the cases, equitable principles such as fairness and good faith and fair dealing are very important aspects as well of corporate governance. We also discussed the role of shareholders in indirect governance. As owners of the company, they don't directly manage, but they work through the board of directors through electing who sits on the board. Oftentimes, if one is unhappy with the corporation's direction, they can always vote with their feet by selling their shares. In looking at voting rights, we know that if one is denied a voting right, they may bring a direct action on behalf of themselves because they are being denied one of their rights of governance. We see this in the Schnell case. If you recall, that was the case in which the board of directors, fearing that there might be some dissident shareholders who would produce another list of potential candidates for the board, tried to move the board meeting ahead more than a month to try to cut off attempts to challenge their authority in the corporation. In the Schnell case, although the court determined that the board, under state law, was entitled to change the date of the annual meeting, that in this case, although statutorily they had acted appropriately, they had violated their equitable duties, their duties of fiduciary duties to the shareholders, by trying to use the law to perpetuate themselves and to circumvent established principles of corporate democracy. In that case, the court found that the action by the board, although statutorily correct, was inequitable, and that the shareholders did not act late in trying to challenge this action in court. Go back to Schnell and see the court's discussion of statutory law as well as equitable principles. And that it was basically unfair for the board to try to cut off efforts at corporate democracy. And so in that case, it was determined that under equity, the original date, a month later, would be reinstated to allow shareholders the opportunity to fully participate in the election of board members. So we see some of that indirect governance at play in Schnell. Take a look at notions of quorum. What are the minimum required numbers of shareholders for votes to be considered valid? The MBCA says that typically you're looking for greater than 50%, a majority of the shareholders that are entitled to vote. Some states have pegged it as low as 1/3 for there to be a quorum. Also, we visit our discussion of the proxy system. That's basically the balloting system in which shareholders vote on proposals as well as election of board members. There can be limited proxies where the proxy holder must vote as instructed by the shareholder, as well as general proxies where the proxy holder is given some discretion because they may learn new information or facts at a meeting, and they can vote then on behalf of the shareholder. We also discuss different types of voting, such as straight, cumulative, voting by class, and disproportionate voting. Go back to our discussion in class, go back to your class notes on that for the variations between each of them, and we also dealt with those in a couple of our skills assignments. So we visit your skills assignments in which you had to look at issues of voting. Aside from the different types or processes for voting that might be found in the Articles of Incorporation, sometimes referred to as the Charter or Certificate of Incorporation, we will also look at the kinds of matters that might be put to a shareholder vote. Things such as voting on who serves on the board of directors, or making changes to the corporate charter or the bylaws. A good example of that is the CA Inc. case that we looked at. In that case, it was a shareholder-initiated proposal, and they wanted to make a change to the bylaws that basically said the board of directors shall cause the corporation to reimburse a stockholder or group of stockholders for their reasonable expenses in connection with nominating one or more candidates in a contested election of directors to the corporation's board of directors. Part of the dispute there was that the board claimed that that proposal was substantive. That is, it was taking away some of the board of directors' actual management control and discretion. The court determined that the proposal in and of itself was process-oriented. It was focused on trying to improve opportunities for dissident stockholders to put others on the ballot for election. So the court there felt that it did not impinge on the board of directors' powers to manage the corporation. So it was an appropriate subject matter for a shareholder-initiated proposal because it wasn't basically telling the board what to do. It was about what the process would be for board decision-making. However, even though the proposal was something within the purview of a shareholder-initiated proposal, the court determined that the proposal as worded violated the board's fiduciary duties by requiring them to reimburse reasonable expenses that may not have been properly incurred to begin with. For example, if you have an individual who has a personal axe to grind against the corporation and they demand to run for the board of directors and they want their reasonable expenses to be paid, well, it might not have been an appropriate candidate to begin with. So it would take away some of the discretion the board would have in how to appropriately spend corporation resources. So although the court said the proposal itself was something that could be initiated by shareholders, that it wasn't a management or substantive proposal taking away board decision-making, that was the proper subject matter, but it was the wording of that proposal that created the problem. And in that case, the court said the shareholders basically had two key alternatives. One was to amend the certificate of incorporation to allow for this payment of reasonable expenses, or they could go to the Delaware General Assembly and seek changes in the law that would allow these kinds of payments as within the duties of the board. Although the court did not mention it, there's actually really a third option. Although the proposal was appropriate for voting, the wording was poorly done perhaps, then maybe they should have included what was called a fiduciary out. That is, the board would be required to pay reasonable expenses unless it would cause them to violate their fiduciary duties. So that was another option as well. So again, look at these issues of what's the proper subject matter for shareholder-initiated proposals, and some can also be initiated by management and put to a shareholder vote. Other matters might be mergers or dissolutions of the corporation. When you're counting the votes, it's traditional that it's majority rules. 50% or more of the shareholders must vote in favor of something for it to pass. While in some bylaws and certificates of incorporation, it could be a plurality. More votes in favor of the proposal than those against the proposal. But take a look at matters that shareholders can bring to a vote. Remember to go back to the CA Inc. case that has a good discussion of proper subject matter and proper wording in light of the board's fiduciary duties. We also discussed the different types of shareholder meetings. Annual meetings, typically the times and dates of the annual meeting, are set in the certificate of incorporation or in the bylaws. There may be a need from time to time for special meetings due to time-sensitive or emergency matters, such as perhaps voting on a merger or acquisition. There can be shareholder meetings or actions without a meeting called written consent actions, where basically what you are doing is either through a unanimous or under the MBCA majority consent, everyone agrees that they're not going to have an in-person meeting, but they're going to circulate a written proposal, typically by email, and then vote by email or some other written form without an in-person meeting. Keep in mind that you have to have appropriate notice of meetings when it comes to shareholder meetings. So you need to have the record date. That is, on what date do you determine who is eligible as a shareholder to vote in an upcoming meeting? The MBCA says it's the day before the first notice is sent to shareholders. That notice should specify the time, date, and place of the meeting, and because of issues of defective notice, it becomes effective upon dispatch, regardless of whether or not one actually received it. So do take a look at this issue of shareholder meetings. And there's an importance of notice of meetings for shareholders because shareholders come and go. People buy stocks and sell stocks, and they have to know when the meeting might occur. And you want to avoid issues of defective notice as regards these various meetings. As we've discussed earlier, the board of directors oversees the C-suite, CFO, CEO, CTO, and basically sets out the main strategies or agenda for the corporation. How do we go about electing those board of directors? Well, under the MBC, it says you have to have a minimum of one director. So you have to have a board of directors with a minimum of one, and they look at a plurality vote to elect them. But of course, we know that can be changed either by the Articles of Incorporation or the bylaws. So that even though the MBCA sets out this minimum standard, as well as the requirement of plurality vote, that can be customized in the bylaws and the Certificate of Incorporation. We did talk about the importance of having odd numbers, such as 3 or 5 or 7 or 9 directors to avoid a deadlock, and recognizing that directors can't be experts in every area, so many times they will delegate their duties to a committee. There might be an HR committee. We've seen, for example, in Claassen, there was a compensation committee. We've seen in other cases that there's audit committees as well as conflicts committees. So you can see that there's a committee structure that can be used by the board of directors to delegate various duties. And we know that the board of directors are bound primarily by the fiduciary duties of care and loyalty, which we discussed in greater detail in Chapter 9. There are inside directors, those that are either the C-suite or corporate employees or people who are significant shareholders in the corporation, as well as outside or independent directors. The idea is the independent directors bring a fresh eye to proposals that are being brought before the board and how to appropriately manage the corporation. Because they are not deep in the corporation itself, they might be able to be more objective. and that we see, for example, to even be on the New York Stock Exchange, it now requires a majority of directors be independent directors to try to avoid issues of conflict of interest or packing the boards with one's pals or cronies that might not be in the best interest of the corporation. You may want to revisit our earlier class discussion of how one goes about selecting the individuals who will serve as directors on the board of directors. Again, look at the certificate of incorporation or the bylaws, which often spell it out. For some corporation, they might name the members of the board when you're just starting out in the articles of incorporation, or they'll have them elected at the first annual meeting. It makes sense to have a staggered schedule where not everyone on the board is up for election at the same time, so you don't lose all of that potential institutional knowledge that the board members may have. And then the compensation for the directors may be determined by a shareholder vote, or in some cases it might be the board of directors deciding their own compensation, but they must do so in line with their fiduciary duties. We also said that the certificate of incorporation or the bylaws should spell out the election process by shareholders or choice by remaining directors if a vacancy should occur on the board of directors. Perhaps somebody dies or retires or becomes physically or mentally disabled and can no longer participate. How vacancies should be filled could either be by election by the shareholders or by the remaining directors, depending on what the certificate of incorporation or bylaws states. We also know that one can be removed with or without cause. And if it's for cause, you're looking at such things as potential criminality by a member of the board, or fraud or dishonesty or breach of their fiduciary duties, such as their breach of their duty of care or their duty of loyalty. Removal could occur at a special meeting of the shareholders because it may be a time-sensitive or emergency matter. In some cases, one can apply to the court for the removal of a member of the board, or in limited circumstances, fellow directors, if it's permitted by state law, may remove one of their members. Although there's a little bit of a concern about that you don't have directors removing someone who may be an outspoken whistleblower on behalf of the corporation. I will say that under the Model Business Corporations Act, the idea under that act, the default is that directors may not remove other directors absent extraordinary circumstances, such as being convicted of a felony. So the NBCA does not, in general, approve of the removal of directors by their fellow directors, but you have to look at state law to see if that has been changed. But the default under the NBCA is that you should only allow directors to remove other directors under extraordinary circumstances, because really the role should be that of the shareholders in determining who serves on the board. As you can see, there's a great deal of similarity between the shareholder meetings and the board of director meetings that might occur. The important thing to keep in mind is that typically with shareholder meetings, because shareholder ranks may change as people buy and sell their stocks, that notice is very important. But with the board of director meetings, for example, the regular meetings that are routinely scheduled based on the terms of either the bylaws or the certificate of incorporation, the view of the courts is as regarding those meetings, this is the board regular meetings now, notice is not required, but is often done so as a courtesy, but it's not required because you're supposed to know as a member of the board when the next regularly scheduled meeting is going to be held. Notice, of course, would be required for special meetings that come up because of time-sensitive or emergency matters, or you could have cases similar to the shareholders where you could have a director's action without a meeting. In that instance, it's based on the unanimous consent in writing of the members of the board, and then written proposals are circulated to the directors for their vote. There's not an in-person meeting. We see a good example of a claim of defective notice in the Claassen case, where Claassen claimed that he was not given appropriate notice that the regular meeting would have an agenda item that would involve removing him as the CEO. But in the Claassen case, which we spent a great deal of time discussing in the class, it has so much rich detail to offer, The court determined that the board was not required to provide advance notice of regularly scheduled board of director meetings, and that any prior discussions among the board members, in which they had a little chit-chat about their thoughts about removing Clausen, were not special meetings, since no formal actions, no formal votes were taken. It was merely sort of pre-meeting discussions, did not amount to special meetings. The court also held that to the extent that Clausen may have had a claim against the board, it was largely equitable in nature, based on the fiduciary duty of loyalty. Were they putting the best interest of the corporation first? However, the court said that Clausen's removal as the CEO was at most voidable, not void. So it was not automatically invalid, but he could raise a claim of validity. But his claim that they had somehow used deceptive tactics, and therefore that should have been a basis to invalidate his removal as a CEO, the court said that was subject to the traditional equitable defenses of laches and acquiescence. The court concluded that the Court of Chancery, the lower court, had properly found that Clausen had acquiesced in his removal as the CEO, and is therefore barred at this point in time in challenging his removal. So the determination is that if you can show that one has acquiesced to the complained of action, as long as the party had full knowledge of his rights and the material facts, if you remain inactive for a considerable period of time, or if you freely do what amounts to recognition of the complained of act, or you act in a manner inconsistent with your subsequent claims that you're repudiating it, then you have in essence acquiesced. So the court found that Clausen had acquiesced because he did not put up a fight at the time of the board meeting regarding his removal. He actually was very helpful in discussing Mr. Hood, who was going to take his position as CEO, his transition into this new role. He also was put on to the audit and compensation committees, and he negotiated a consulting agreement, which, although it never went into effect, he did negotiate it with them, basically accepting the fact he was no longer an Allegro employee or agent. So think about issues of acquiescence, sometimes referred to as ratification, that occurred in Clausen. And Clausen was a good example of a dispute over the issue of notice and as to whether or not deceptive tactics would be appropriate. Now, the court said, we don't approve of deceptive tactics, but here he acquiesced in his own removal and therefore would remain bound by it and could not challenge it anymore in court. As we know, the corporate officers are the ones that are responsible for carrying out the day-to-day corporate operations and executing on the different agenda or strategy items that have been given to them or delegated to them by the board. They are selected by the board, they are supervised in essence by the board, and of course are subject to removal by the board. We see that in Clausen. He was the CEO, the board was removing him. They are employees, agents of the corporation, and therefore are bound by the fiduciary duties that we discussed way back when. We also had some discussion about what you typically will find, the different roles in the C-suite, but we know that those roles are expanding now as corporations perhaps grow larger. The number of people who are considered officers has broadened, but we know that there's typically a CEO who's the president, various number of vice presidents, chief operating officers, chief technology officers, chief information officers. Even we talked about the growth of chief revenue officers who are basically the head of sales. We have the secretary, who plays a very important role in managing the meeting minutes and authenticating corporate records, and then the treasurer, sometimes referred to as the CFO or the comptroller. In many instances, the CFO is also the secretary of the corporation, but these roles have expanded and contracted over time, and you have to look at the articles of incorporation or the bylaws to see what kinds of officer roles have been permitted. But remember, these are the folks that manage the day-to-day corporate operations, whereas the board sets the overall strategy and the shareholders indirectly govern through the board. In the course, we also discussed corporate liability issues, including potential violations of fiduciary duties. In Chapter 1, we see a case, Midland, that deals with piercing the corporate veil. But now that you have a better sense about what a corporation is, it seems like this is the right point to insert that case. Piercing the corporate veil is something that is very difficult to succeed on. Courts generally require a compelling cause before they will pierce the corporate veil. That is, one of the typical characteristics of the corporate form is limited liability. That is, all that the shareholders can lose is their investment and not have personal liability for the corporation's debts or wrongdoings. But keep in mind the notion of piercing the corporate veil does exist. And if in those limited circumstances you can find or show a compelling cause for the court to pierce the corporate veil, then the shareholder owners may have personal liability for either the debts or the wrongdoing of the corporation. We know that there is no set formula for determining whether or not a court will pierce the corporate veil. Different courts use different standards. But we do have the Midland case. And the Midland case gives us a good overview of various factors that a court would consider in determining whether or not they will pierce the corporate veil and make the shareholders owners personally liable. The Midland case involved two companies. Midland that installed carpets for a company called Window Treatments. Window Treatments was a corporation, but it was involuntarily dissolved by the Secretary of State for its failure to pay its taxes. However, despite no longer being a corporation, the sole shareholder, sole director, and CEO of Window Treatments, Burley, continued to sign contracts with Midland and other third parties, claiming that he was a corporation when he no longer was. He also made claims in court and to Midland's attorneys and to Midland that the corporation would be willing to pay the outstanding monies owed to Midland under the contract, even though the corporation no longer existed and Burley had moved on to a brand new corporation, leaving many of his creditors behind without paying his debts. The court had to decide whether or not Midland could pierce the corporate veil and go after Burley personally as a shareholder owner of Window Treatments. And so the court looked at a variety of factors. One was the level of the shareholder owner's domination or disregard of the separate corporate entity. We know in this case that Burley was the only shareholder, he was the only director, and he, in essence, was the only CEO of the corporation. So clearly, he dominated any of the decisions made by the corporate entity. He also failed to observe corporate formalities. He didn't pay his state taxes. He didn't file his annual reports. He didn't have an annual meeting, and he didn't have insurance, which is typical for corporations in order to protect themselves and third parties in cases of liability. The court also examined the degree of injustice that Midland would suffer if they upheld the corporate form and did not allow them to go after Burley personally. There was a lot of money that was owed to Midland. It was another small company, and it wasn't fair to them that Burley would basically say, I am a corporation, when he knows he's not, and then move on, let that corporation die off with almost no assets in it, and then create a new corporation and leave his creditors, in this case Midland, without being paid. So it would be very unjust for Midland not to be paid and for Burley to be allowed to continue on with corporate activities in a new company that only added tinted windows to the variety of services that they offered. The notion of was there any fraud, contravention of law or contract, or public wrong involved? Well, you could say there was a fraud because Burley was signing contracts, including contracts with Midland, claiming that they were still a corporation when he knew that one no longer existed. He also contravened his contract by not making his payments, And you could say there was a fraud or a public wrong when he lied to the tribunal and to Midland's attorney and to Midland about the corporation being willing to pay all the money they owed. We also see that insolvency can be a basis, one of the factors the court will consider. But we know that many businesses are not successful, so the court will often say that just being insolvent is not necessarily enough to show that one can pierce the corporate veil, because businesses sometimes are successful and sometimes they are unsuccessful. So they're really coupling it with these other factors. So insolvency, or some kind of lack of economic worth, that is making sure you have no assets that creditors can go after. Well, if you're doing this as part of a larger effort to unjustly conceal your assets from creditors, or as a way of avoiding paying your taxes, so it's insolvency kind of coupled with this larger effort to avoid paying creditors or avoid paying taxes. That could also be a factor that would help one find in favor of piercing the corporate veil. And the court said that clearly in this case, Burley made certain that there were no assets. There was some showing that he was taking assets away from the corporation to avoid any kinds of creditors being able to attach the assets, and we know that he failed to pay his taxes. So Midland is a good example where a lot of the factors supported piercing the corporate veil. Recognize that some of these same factors or this similar approach will be used in piercing LLCs for liability as well. But keep in mind, it is generally very, very difficult to pierce the corporate veil absent a showing of a compelling cause. So although Midland is a good example of an entity that was successful in piercing the corporate veil, it is usually a very difficult task and one that very few will succeed on.
In Chapter 9, we took a closer look at the fiduciary duties owed by officers and directors to the corporation. They primarily owe the duty of care and the duty of loyalty to the corporation. And we looked first at the business judgment rule, which I think most heavily relies on the duty of care, but also has aspects of the duty of loyalty, putting the interests of the corporation first, mixed together. And under the business judgment rule, there is a rebuttable presumption that officers and directors in their decision making are making their decisions on an informed basis, in good faith, based on their honestly held belief that the action they are taking are going to serve the best interest of the corporation. So that presumption already is in place, and if one wants to challenge a decision by the officers or directors, they must be able to successfully rebut that presumption, which can be quite difficult, because normally you must show that the board or the officers in, in their decision-making process was one that was grossly inadequate, or was tainted by a lack of independence or a conflict of interest, or that the decision-making was completely irrational. And so that's a pretty high standard to meet in order to show that you have rebutted the presumption that officers and directors have acted in accordance with the business judgment rule. And even if you are successful in rebutting that presumption, the burden of proof then shifts back to the board or the officers to show that their decision was entirely fair to the corporation. So when you look at the rebuttable presumption that decisions made by officers or directors are informed and in good faith, well, you're looking in essence at issues of duty of care and of loyalty. And the fact that they honestly believe that they are serving the best interest of the corporation also goes to that duty of putting the interests of the principal above all else, including your own self-interest. It is very rare that officers and directors are held personally liable because of the presumption under the business judgment rule. We see that in the Smith case, Smith versus Van Gorkum, or TransUnion, that was an excellent example of where the board and officers had failed to make a truly informed decision based on good faith related to their honestly held beliefs about the best interests of the corporation, where we see that the decision was made in haste. There wasn't any use of experts, legal or financial, to help them in the process. There was a complete lack of board preparation. They didn't really show a duty of care because they did not even have, nor did they review the relevant documents on the merger. There was a lack of questioning or involvement by the board as to what Smith had done to get the company to the point that it was being offered this premium amount on the shares. And it was clear that a lot of upper management was concerned that the company was undervalued and that the bid being put on this company continued undervaluing the overall benefit that they could have received in a merger or acquisition by another if they had put it out into the open marketplace. So take a look at the Smith case. It's a good example of the business judgment rule and one of the rare instances in which the court determined that the officers and directors were personally liable for not living up to this rule. The notion of the corporate opportunity doctrine is one that falls squarely within the fiduciary duty of loyalty owed by officers or directors to the corporation. And we know that courts have developed different tests on determining whether or not there has been a violation of the corporate opportunity doctrine. But the basic notion of the corporate opportunity doctrine is that a director may not usurp or take for themselves a business opportunity that properly belongs to the corporation, at least not without offering the opportunity to the corporation first. And the corporate opportunity doctrine goes back to this notion of the duty of loyalty, putting the interest of the corporation above your own self-interest, your own profit, and also this idea of no secret profits or no conflict of interest in your business activities when you are in the role of officer or director of the corporation. And take a look at the Northeast Harbor case. That was the case involving the golf course and the president of the golf course corporation going around and buying different plots of land that were adjacent to the golf course at a time when the corporation did not want to have development near the golf course, and then later on seeking to make money by developing house subdivisions on that property. So take a look at that case. It's a good case in the sense that the court also spends time reviewing sort of the three key tests that are utilized under the corporate opportunity doctrine. We know that Florida follows the Delaware line of business test, which is the idea that an officer and director may not take a business opportunity for themselves if the corporation is financially able to exploit the opportunity. We saw in the Northeast Harbor that the argument from Harris, who was the president of the golf course corporation, basically thought that the golf course corporation really didn't have the money to buy this land, so they weren't financially able to exploit the opportunity. Her argument was also that the opportunity was not within the corporation's line of business, that their business was handling the golf course and golf course membership, but that their line of business, their business objectives, were not consistent with the idea of real estate development. They were not real estate developers. This wasn't a typical activity carried out by the corporation. The corporation has an interest or expectancy in the opportunity, where her argument was that they didn't, because they didn't want to develop land around there. So why would they have an interest in potentially developing the land around the golf course? Because they didn't have an interest in that. And that by taking the opportunity for yourself, you're placing the officer and director in opposition or at odds with the fiduciary duties owed to the corporation. Her view is that after the fact, she told them about these purchases, although she had said that she was doing it to protect the corporation. Her view was, well, that didn't put her at odds with the corporation at the time she was buying it. She had not necessarily considered development, that was something she thought about later. So under the line of business test, the officer or director may not take the business opportunity if the corporation is able to financially exploit the opportunity is within the corporation's line of business, the corporation has an interest or expectancy in the opportunity, and that by taking the opportunity for themselves, the officer or director is putting themselves in conflict with or at odds with their fiduciary duties owed to the corporation. However, under the line of business test, the officer or director may take the business opportunity for themselves if the opportunity was presented to the officer director in their individual, not their corporate capacity. Now, we do know in the Northeast Harbor case that at least some of the parcels of land in the Gilpin property were presented to Harris because of her role as a president of the Golf Course Corporation. So she might have had some difficulty there because Clearly, they didn't come to her as an individual capacity as a person on the street or as a real estate developer, but only because of her corporate role. The opportunity is not essential to the corporation. The corporation has no interest or expectancy in the opportunity, and the officer or director has not wrongfully employed corporate resources in pursuing or exploiting the opportunity, such as corporation funding or letterhead or staff assistance in it. So, under the line of business test, the trial court in Northeast Harbor found that Harris had acted properly, but you could also see that there are arguments against that because the land was only brought to her as an opportunity because of her role as president of the organization. But ultimately, the Northeast Harbor case did not like the line of business test because they felt that businesses and their activities do change over time. And a business has to be adaptable to the world around it, and so it can be very hard to determine what exactly is within a corporation's line of business. But this is the test followed in Delaware as well as in Florida. Aside from the line of business test that's embraced in Delaware and in Florida, we also have the fairness test and the ALI approach. The fairness test comes from the Durfee case in my home state of Massachusetts. And like all corporate opportunity doctrine cases, it's a very fact-intensive review, but it's one in which the court will look at the facts and make a determination about what is fair and equitable under the circumstances. And the emphasis of the fairness test is to ensure the protection of corporate interests over personal profit. The fairness test gives a broad discretion to the court to determine what is fair and equitable standards of conduct. But some have criticized it because it does not provide perhaps enough guidance to officers and directors about whether or not their conduct will be viewed as fair and equitable after they have carried out their activities. It may be very hard for an individual to, on their own, if there's personal profit or potential conflict of interest, they may find it hard to objectively determine what is fair and equitable under the circumstances, and even those that are trying to act properly may not have enough guidance about what a court will likely find at a later date. The Northeast Harbor case then embraces the ALI approach, where the emphasis is on prior, good faith, full disclosure of the opportunity. So we know in Northeast Harbor that Harris did not disclose her purchases of this land until after the fact, so it was not done prior. And there was a question about good faith because she said she bought the land to protect the golf course corporation, but it became clear later on that perhaps at the heart of it was a desire to develop the property later on for personal profit. And aside from this prior good faith full disclosure of the opportunity, the corporation has to reject the offered opportunity. The notion being that the corporation can decide whether or not it's in its interest, and if they reject it, then you are not violating the corporate opportunity doctrine by participating or taking advantage of that potential opportunity. And the ALI approach broadly interprets corporate opportunity. It doesn't limit it to the line of business, as we see in the Delaware-Florida test, but looks to whether or not the activities or the opportunity is closely related to the corporation's business. So, for example, with the golf course, although real estate development is not in their line of business, it was something that they had discussed about whether or not they wanted the land to remain undeveloped around the golf course, or whether it might make sense to have some kind of development around the golf course, and that even though they weren't involved as real estate developers, certainly land is at the heart of both real estate development and the golf course, so they are somewhat closely related. Or the opportunity results from the individual's role, fiduciary role, as an officer or director in the corporation. And clearly in Harris's case, at least as regards the Gilpin property, she only learned about the opportunity because she was the president of the golf course corporation. So it's this notion that we're not going to be so narrow in our approach by looking only at what's in the line of business. We're going to look at what's closely related to the corporation's business activities, or we're going to examine whether or not the officer or director had a fiduciary role or position in the corporation, and that the opportunity only came to them through that role. Now, if somebody does make a good faith but defective disclosure about a corporate opportunity, the way for them to cure that is to have the corporation ratify its rejection of the opportunity. So if the facts should change on the ground, or they decide they want to do something different with an opportunity than they had originally disclosed to the board or to the corporation, then it's their obligation to come back and make another good faith disclosure and seek a confirmation from the corporation, a ratification that it is rejecting the opportunity that they're considering. So in Northeast Harbor, because Harris had not made this prior good faith disclosure, and because land development was closely related to the golf course's business activities, as well as the fact that as an officer and director, she had a fiduciary role in the position in the golf course corporation, and she only really got the opportunity to participate, at least in the original land deal, because of that role, that she had violated the corporate opportunity doctrine in that case. Aside from issues of conflict of interest and self-dealing that we also discussed in this chapter, we also talked about caremark claims, which can involve either failing to act or actions that violate one's duty of loyalty. And with the caremark claims, take a look at the caremark case, in which we had a sort of a questionable payments to physicians involving Medicare and Medicaid that were listed as consulting agreements or research grants that the Department of Justice later determined violated federal law on kickbacks under Medicare and Medicaid, and that ultimately the Department of Justice brought criminal indictments, and it was settled with the company through a settlement agreement which indicated that no officer or director had knowingly participated in this activity, and that they had not shown any kind of willful ignorance, but due to the activities, the company was penalized $250 million, required to set up an ethics and oversight committee to deal with these problems in the future. And because of that, shareholders brought a derivative action claiming that the losses were due to the failure of the board to show appropriate loyalty, and therefore they were demanding that the board and officers be held personally liable for the $250 million in losses from the Department of Justice settlement. So when you're looking at a caremark claim, you're often looking not at actions but failure to act, although in some cases it could be action, but often it is failing to act and not acting in good faith. And when you have a caremark claim, you are claiming that there's been, by the board and the officers, a sustained and systematic failure to properly oversee corporate activities that leads to corporate losses. And normally it goes and looks at whether or not there are appropriate controls or flows of information in place so that there can be proper oversight and control of employees. And the breach of this duty basically says that there was not proper information flows, there was a lack of proper oversight, and by doing so that they failed to adequately control employees, leading to corporate losses. If you are a plaintiff, typically a shareholder who's bringing a caremark claim under a derivative suit, you are alleging that the officers and directors knew or should have known that violations of law were occurring, and that the officers and directors took no steps in good faith to prevent or remedy the situation, and that their failure to act proximately caused the corporation's losses. So in the caremark case, the shareholders alleged that the officers and directors knew or should have known that this program of research grants and consulting agreements with physicians was in violation of the law. However, the court determined that they had sought legal assistance, and that their legal experts had told them that although the programs were contestable, they were well within the law. So it was not that they knew or should have known of these violations. You also have the fact that the Department of Justice settlement made it clear that they had not participated in, nor were they willfully ignorant of these criminal violations. The plaintiffs could not show that the officers' directors had taken no steps in good faith to prevent or remedy the situation because there were systems in place that were allowing for a consistent flow of information to the board. So it wasn't that no steps had been taken. Steps had been taken by these information flows, but perhaps there needed to be an improvement on this in order to avoid this kind of conduct in the future. And although the shareholders could argue that the failure had approximately caused these corporate losses, it's important to keep in mind that the determination was that they had acted appropriately and had not been willfully ignorant, and they had appropriate systems in place. Therefore, there wasn't a failure by the board or officers, and that there were improvements, of course, going to be made over time. So in the Caremark case, even though this sets up a standard, it was found that the officers and directors had not violated their duty of loyalty by their failures to act in good faith. Now, after the Caremark case, though, a lot of places like Delaware have indicated that to determine the lack of good faith requires more than gross negligence. It often requires an intentional dereliction of duty. So, in essence, it would suggest that you were involved or even condoned violations of law. So that's a pretty high standard to meet. But there are many jurisdictions that still follow the Caremark approach. And when the plaintiffs are successful, they could show that the officers and directors had violated their fiduciary duties. They just were unable to do so successfully in the original case. So take a look back at Caremark and how the court set out the standard and then determined that the officers and directors had not failed in their duties.
All right, folks. In Chapter 10, we looked at shareholder rights and protections, and we did so with a special focus on the closely held corporation. We know that at common law, shareholders have certain immutable rights. And one of those, of course, is the right to be informed about corporate affairs because a shareholder is an owner of the corporation, and the right to a good faith inspection of corporate books and records. If either of these rights are improperly denied, then the shareholder can bring a direct action against the corporation. One of the areas of concern is often this issue about the good faith inspection of corporate books and records. Traditionally, at common law, one had only the right to look at the list of shareholders and the stock ledger that spelled out the number and classes of shares. Outside of those two sort of limited records, then if you were a shareholder interested in additional information, you are required, and the burden is put on you, to establish that you have a proper purpose to go outside of merely looking at the shareholder list or the stock ledger of the number and classes of shares. If you are permitted the opportunity to inspect the corporate books and records, generally it has to be done within the terms of reasonableness. You have to give reasonable notice to the corporation. It has to be done during reasonable business hours, and you may be asked to pay reasonable costs for copies or other administrative fees. Some examples of bad faith requests to inspect books or records that may be coming from a shareholder might be a shareholder who wants to look at the records so they can find out about the corporation's customers and then solicit them for their own business, or to steal or misappropriate corporate trade secrets that they might pass on to competitors. What if the stockholder is merely pursuing an individual political goal, or is bored out of their mind and just wants to show up out of sheer curiosity? There may be even occasions where a shareholder is seeking to harass the corporation, perhaps through multiple visits and demands for the same corporate records, and is doing so perhaps out of a desire to harass the corporation or out of personal animus against the corporation. Maybe they're an ex-employee, or maybe they're an unhappy shareholder and they just want to create trouble or turmoil at the corporation by constantly demanding to inspect books or records. But generally, you have that common law right, and it's generally been limited to the shareholder list and the stock ledger. Anything outside of that, you must show a proper purpose and do so within the bounds of reasonableness. This notion of the right to good faith inspection of corporate books and records has both a procedural component and a substantive component. Under the procedural aspects, one must comply with statutory mandates about the process for requesting the right to look at corporate books and records. Typically, your request has to be in writing, normally under oath, and again, it has to be for a stated stockholder purpose. Normally, that written request is directed to a corporate's registered officers or principal place of business. If your attorney is looking at the records on your behalf, you may need to have a power of attorney provided to them, indicating that they are acting on behalf of a third-party stockholder. Some statutes impose waiting periods and minimum stock ownership amounts in order for one to be allowed to look at corporate books and records. Based on a class question, I did go back to the Model Business Code, the Model Business Corporation Act, and that does not place any minimum stock ownership amounts. It basically says that you have to follow the appropriate process, but it does not spell out any particular stock ownership amounts. That you can look to state statute or state distinctions to see if a state does have some potential minimum amount of stock that one must own before they can make this request to look at the corporate books and records. There's also a substantive aspect of it. We've talked about this briefly before, and that's the issue of whether or not the inspection is being done for a proper purpose, reasonably related to one's role as a shareholder. You can only inspect those records that are essential and sufficient to achieve your stated proper purpose, and the information sought must not be available from another source. If it's unavailable from another source, then that supports the notion that you should look at it at the corporate headquarters or the registered office or principal place of business. However, if the information sought is available from another source, then in some instances you might be expected to go there and look at that information. Also, we have to ask whether or not the information has been previously provided by the corporation. So if you can show you have a proper purpose, there's the further limit of showing that's essential and sufficient, the records that you seek to achieve your proper purpose, that the information sought is unavailable from another source or has not been previously provided by the corporation. Also, a court may also, in cases where there's a dispute about whether or not a shareholder may look at a particular corporate record, there may be a determination by the court as to whether or not the stockholder has inappropriate ulterior motives for wanting to inspect the corporate books and records. Take a look at the Quantum case that we discussed in class, which dealt with a minority shareholder, and in that closely held corporate situation, most of their requests were viewed as having a proper purpose, that the records they were seeking to look at were essential and sufficient for their purpose, that they weren't available from another source, and had not been previously provided by the corporation. So they were able to get many of the things that they had requested. There were a few areas where the court said that the material was not necessary, was not essential and sufficient. For example, they wanted draft financial statements that had yet to have been audited, and the court's view is, well, wait till you get the final ones because that will incorporate much of what you're looking for. And also they were not allowed to look at a contract that Plume had with the Japanese tobacco company because of a confidentiality clause in that contract, and that the sales forecast would already capture that information. So take a look again at Quantum on this issue. But keep in mind, state statute does have an impact because there may be peculiarities in each state about who really does get to look at the corporate records.
An important issue to consider when shareholders are bringing actions claiming a breach of fiduciary duties and are requiring the production of corporate books and documents, one must keep in mind that some of those documents may be covered by attorney-client privilege. In the Garner case, we have what's called the Garner exceptions to attorney-client privilege, which may allow for the production of documents covered under attorney-client privilege when there is a legal action brought by the shareholders for the breach of fiduciary duties. It is, like many things in corporation law a fact-intensive review in which the court must look at the nature of the claim being brought by the shareholder and whether or not the production of the attorney-client privilege documents is appropriate. Under this review, the shareholder must show cause why the attorney-client privilege should not be upheld. And in showing cause, the court will have to examine the nature of the shareholder's claim against the officers and the directors, whether the allegations and claim criminal, illegal, or actions of doubtful legality by officers and directors, whether or not letting these documents be produced risk revealing proprietary information that needs to be kept confidential for reasons other than attorney-client privilege, and whether or not the shareholders are engaging in a fishing expedition, just looking at a bunch of documents trying to find out whether there's a basis for their claim, or is there an identifiable communication or document, perhaps a memo between the attorneys and the officers and directors that point to this illegal conduct. So the shareholder has the burden of showing cause as to why the privilege should not be upheld. The court then has to assess whether the documents they are seeking are necessary and essential to show the breach of the fiduciary duties. And then, as we've seen before in our discussions, the information, the court will say, is this information available from another source to try to avoid breaking the attorney-client privilege on the document? So the Garner exception is important for us as attorneys, because when a shareholder or their attorneys are demanding documents for production, we must consider the attorney-client privilege and whether or not the Garner exception may allow this documentation to be provided. Continuing on in our discussion of closely held corporations, we also see this notion of heightened fiduciary duties of good faith and loyalty when controlling shareholders are acting. Take a look at the Donahue case, in which the majority shareholders bought out the interests of their retiring father and did not provide that same opportunity to minority shareholders in the Donahue family. It's a good example of the power imbalance and the risks of controlling shareholders in a close corporation favoring themselves over minority shareholders. It's particularly troublesome because in a closely held corporation or one that's privately held, there is generally no public trading of stock. So there may be no other way for a party to find a market for their shares if they wish to exit the investment. So take a look at Donahue, a good example of heightened fiduciary duties. Most states follow Donahue's call for heightened fiduciary duties by controlling shareholders, who are typically the majority shareholders, in privately held or closely held corporations. However, states like Delaware depart from the Donahue rule. Their argument is that if you want more protections, you need to bargain for it as the minority shareholder. But after the Donahue case, we see that there's the Wilkes balancing test, which also deals with claimed violations of heightened fiduciary duties, and it helps to clarify the Donahue rule. And basically, it calls upon courts to carefully analyze the actions of the controlling shareholders. So like many other aspects of corporation law, it requires a fact-intensive review of the disputed circumstances. The controlling shareholders must show that they have a legitimate business purpose for their actions. This will allow flexibility for proper decision-making policies by the controlling shareholders. But the minority shareholders, in response, must demonstrate that the same legitimate objective being claimed by the controlling shareholders can be achieved in a manner that's less harmful to the minority shareholders. So they must pose an alternative course of action that would protect their interest as well. And so the court is put in the position of weighing the claimed legitimate business purpose raised by the controlling shareholders against the practicability of the proposed less harmful alternative being proposed by minority shareholders. But keep in mind that in most states, there is this requirement of heightened fiduciary duties when controlling shareholders are taking an action, particularly one which might be viewed as squeezing out or freezing out minority shareholders from opportunities. In Chapter 13, we took a brief overview of securities regulation and anti-fraud rules. The area of securities regulation is a complicated and detailed one, and you cannot learn in a class that's primarily about business organizations about all of your obligations under securities law. If you're interested in this field, it's important to consider taking either a separate course or a continuing legal education seminar that will help to give you a better sense of this field overall. We'll only touch upon it briefly here as part of the legal and fiduciary duties of officers and directors. When you look at securities regulation and anti-fraud rules, we touched upon three main important acts. The Security Act of 1933 deals with the registration and disclosure mandates for initial securities offerings. All securities that are offered for sale in the United States must be registered with the SEC, or you must show that you qualify for some exemption from registration. The Securities Act of 1934 deals with the regulation of buying or selling securities after the initial securities offerings, and deals with financial reporting requirements for publicly traded companies, including registration. And then Sarbanes-Oxley Act of 2002. You will hear often referred to as SOX compliance. This was in the wake of Enron and other financial scandals, in which determinations were made that it was important to establish the proper internal audit controls to avoid this kind of financial malfeasance, and also demand certification of the reliability and accuracy of corporate disclosure documents by corporate management, so that those at the top could say, "Oh, I never knew what happened." Well, now you have an obligation to know and certify the accuracy of information that you are disclosing regarding the financial state of the corporation. We'll look at primarily the Securities Act of 1933 and the Securities Act of 1934 in our discussion of the key concepts in Chapter 13. The Securities and Exchange Commission likes to say that its regulatory authority is based on two main pillars: flexibility and disclosure. For our purposes, we're going to look more at the disclosure end. And in some senses, the two main pillars for that are registration and anti-fraud. With registration, there's strict liability for your failure to register securities unless you're exempted by law. It does not require a showing of an evil motive or an intent to deceive. Scienter. That's not required. It's simply making a public offering or sale of a security that has not been registered makes you automatically liable, unless you can show you're exempted. You must be trading it in interstate or using interstate means, like the internet. If you didn't register and you're not exempted, then the SEC may impose both public or private civil liability. So keep in mind that there's this obligation that if you are going to be offering securities for sale, then you must register. One of the exemptions that you might be familiar with are cases in which there's crowdfunding, in which in exchange for a donation you might get a free DVD of the movie that's made or a free t-shirt of the game that somebody is trying to develop. That might be exempt. But in most cases, if there's a public offering or sale of a security, you must register. Whether you knew or didn't know, whether you meant to cause harm or not, you must register. On the anti-fraud piece, though, that applies to both public and privately traded securities. The registration piece only applies to public offerings, whereas the anti-fraud applies to both public and privately traded securities. It does require scienter, that sort of evil motive, that intent to deceive. To bring a securities fraud claim, the plaintiff must allege that each defendant made misstatements or omissions of material fact with scienter, an intent to deceive, in connection with the interstate purchase or sale of securities. Remember, it could be either public or private. That the plaintiff relied upon these misstatements or omissions of material fact, and the plaintiff's reliance was the proximate cause of their injury. In the anti-fraud area, the SEC may impose both civil and criminal liability. So keep in mind registration duties and anti-fraud, two of the key pillars of disclosure under securities regulations. Before one has an obligation to comply with security laws and regulations, you have to first know what a security is for regulatory purposes. The famous Howey test is what generally is used to determine whether or not a particular transaction involves a security. We might normally think of stocks and bonds as securities, but it's much broader than that in determining what comes within the regulatory ambit of the securities regulations. Under the Howey test, it defines an investment contract to include broadly the investment of money in a common enterprise, although there's a bit of a split in the circuits between that, and with the expectation of profits to be solely derived from the managerial or entrepreneurial efforts of third parties or promoters. Keep in mind that that third prong has been updated. It was initially that the profits had to come solely from the efforts of promoters or third parties, but now that has been interpreted to mean merely predominantly from the efforts of third parties or promoters. When you look at the mutual benefits case, you see this revised version of the Howey test at play. The court looks at this issue of investment of money. The money being invested here was what was called viatical life settlements, which allowed terminally ill folks to draw on the value of their life insurance policies before death. This typically aided them in paying medical and other bills during this time period in which they knew their life would be short. In this case, the investment of money was for a common enterprise. Mutual Benefit Corporation was the one who procured these settlements and sold fractional interest in the settlements to investors. So this was the common enterprise between them. And then there was an expectation of profits to be derived predominantly from the efforts of third parties. The third party here was not the investors, but Mutual Benefits Corporation, which was the one that was responsible for locating the policies, negotiating the purchase prices, bidding on the policies, and obtaining life expectancy evaluations of the individual insured parties. NBC then solicited funds from investors directly and through agents to pay for these, and then individuals were given a maturity date and a promised return of anywhere from 12 to 72% on these settlements. In this case, the court determined that the inquiry really turned on whether the profits from the investment were derived predominantly from the efforts of others. And the court determined that in light of the significant entrepreneurial and managerial efforts involved in locating, negotiating, and performing the life expectancy evaluations, the court was convinced that the investments in that case, the viatical settlements, were indeed investment contracts that could be viewed as securities and would fall under the coverage of federal securities laws. So keep in mind, folks, that when you think about securities, don't limit it to stocks and bonds. Apply the Howey test, and that will help to make that determination. Now, as regards the common enterprise aspect of the Howey test, I noted that there's a split in the circuits. Some accept the notion of horizontal commonality. There has to be interdependence among the investors. That is, that they're pooling together their funds, or there's some kind of prorated distribution among the investors. Others will look at the vertical commonality, the success of the investors being dependent on the success of third-party or promoter efforts to secure a return. Whichever one applies, there has to be this notion of the common enterprise. And the court found that here in the mutual benefits case. So take a look at the mutual benefits case. It's an example of where you might see something that doesn't look like a stock or bond, but is still a security, and as an investment contract, it comes under the regulatory authority of securities regulation. When thinking about the anti-fraud rules of the Securities and Exchange Commission, many of us are probably familiar with the concept of insider trading. It's one that's often in the headlines. When we think about insider trading, we're thinking about the Securities Act of 1934. There are two basic theories of insider trading: the classical theory and the misappropriation theory. The classical theory was the notion that only corporate insiders could be involved in insider trading, meaning that you had to be a corporate officer, a corporate director, or an employee of the corporation in order to be viewed as an insider. To violate the securities law, the corporate insider would trade on securities of their own corporation based on material, non-public information. So say, for example, you're working in the financial department of a corporation. You hear word from meetings with the CFO that the company is going to suffer a big loss in the coming quarter. You sell your stock because you don't want to have to see the decline in the stock hit your own bottom line. In that case, you are trading on information that is not available to the general investing public. Because it's material, the big loss that's coming up that could impact the value of the stock, and you're trading on it as a corporate insider and employee, then you've breached your duty of confidentiality. This information you learned in confidence as an employee. Remember, we're back to our old agency/fiduciary duties, the duty of confidentiality. You only know this information about the upcoming loss due to your position within the corporation. Under the classical theory, if you did trade on this material non-public information, then that is insider trading. It could also swing the other way if you know about some big development that will send the stock values skyrocketing and you run out and buy more stock because you want to have a personal profit once this big thing happens. Well, you clearly have information that's not available to the general public, and that would come under the classical theory of insider trading. There's also the misappropriation theory. This recognizes the fact that one might be a corporate outsider who is also trading on material, non-public information for their benefit. For example, if you're a corporation, you might have to deal with law firms, including paralegals, law student interns, legal secretaries, who may have access to this information that is known only between the corporation and its attorneys. It could be banking or financial expert that a corporation has to consult, who may have confidential information that they will need to review in order to help the corporation assess its needs. Well, these folks aren't employees, they aren't directors, and they're not officers of the corporation. So they're not the classical corporate insiders. But they are corporate outsiders who are violating their obligations by misappropriating confidential information for the purposes of securities trading. In that case, the breach of the duty is defrauding the insiders because they are an entrusted outsider who has used confidential information that they learned from the insiders for their own benefit. So you're basically misappropriating information that was disclosed to you in confidence, either as a lawyer, a banker, or financial expert, and then using that to try to make commercial gain in the marketplace. Whether it's the classical theory or the misappropriation theory, these two are the key theories of insider trading. And these are the key theories for liability, whether you're a corporate insider or a corporate outsider. But we'll see in a moment that, of course, that has been expanded beyond corporate insiders and corporate outsiders to those who might have been tipped off by an insider or an outsider with confidential information. That's tippee liability that we'll talk about in a moment in the Newman case. However, the notion of insider trading has moved away from just a reliance on either corporate insiders or corporate outsiders under the classical and misappropriation theories. Now we have the potential of insider trading based on what's called tippee liability, which we saw in the Newman case. Tippee liability does not really center on the use by corporate insiders or outsiders of non-public information. In the case of tippee liability, the focus is more on the violation that flows from the person who gave the tip breaching a fiduciary duty. So we've moved now beyond, not excluding, but beyond the classical and misappropriation theories. We also now have tippee liability. In order to succeed on tippee liability, the government must prove beyond a reasonable doubt that the tipper or the corporate insider was entrusted with the fiduciary duty, that the tipper or corporate insider, which it often is, breached their fiduciary duty by disclosing confidential information to a tippee in exchange for the tipper's personal benefit. Remember, that tipper is typically a corporate insider, but it could be a corporate outsider, like a law firm, bank, or financial institution, that basically learned about this confidential information from the corporation, and they were supposed to keep it confidential, but did not. The tippee has to know of the tipper's breach of their fiduciary duty, and that it was disclosed for the tipper's personal benefit. And the tippee still used the information to trade in a security or to tip another individual for tippee's personal benefits. So it's this notion of a quid pro quo between the tipper and the tippee, each giving the other a benefit. In the Newman case, the court looked at the issue of tipper-tippee liability involving more remote tippees. It also provides a really interesting review of the classical and misappropriation theories. But in the Newman case, the court said that to sustain a conviction for insider trading on the Dell tips, the government must prove beyond a reasonable doubt that the tippee knew that an insider disclosed confidential information, and he did so in exchange for a personal benefit. It shows the court difficulty in applying and interpreting securities laws and the dangers of precision that will lead to loopholes that can be exploited by the crafty and the dishonest. In this case, the court found no criminal liability by the remote tippees. The court held that the evidence was insufficient to sustain a guilty verdict against Newman and a co-defendant, because it found the evidence of any personal benefit was insufficient to establish the tipper liability from which the defendant's tippee liability would flow, and because it found that even if the evidence offered on the issue of personal benefit was sufficient, the government presented no evidence that Newman and his co-defendant knew that they were trading on information obtained from an insider's violation of their fiduciary duties. So the court took a very strict and narrow view. Keep in mind, though, that there was a subsequent case that went to the Supreme Court, the Salmon case, and it looked at this notion of personal benefit quid pro quo between the parties. And the court determined that in the December 2016 decision, the Supreme Court, and it was its first major opinion addressing the scope of insider trading in almost 20 years, they said when considering insider trading liability, it can arise now where a tipper makes a gift of confidential information to a trading friend or relative, but receives no concrete financial or other tangible benefit in return. So in this subsequent decision by the Supreme Court, they moved away from the strict notion that there must be a quid pro quo between the tipper and the tippee, and saying that giving someone a gift of confidential information without expecting anything in return could still be viewed as insider trading, because in essence, you are still breaching your fiduciary duty to keep something confidential. Our final chapter, chapter 11 this semester, dealt with changes in the corporate structure, and we looked first at amending the Articles of Incorporation. After a corporation is in place, there can be a variety of reasons why you might want to amend the Articles of Incorporation, including changing the corporate name, increasing the number of shares you wish to issue, or perhaps a merger or acquisition. Under the MBCA and Florida statute, you may amend your Articles of Incorporation to reflect any legally permissible provision under state statute. So there are broad opportunities potentially to amend one's Articles of Incorporation. The typical procedure for amending articles is initially for the board to undertake a review of the proposed amendment and to discuss it at the board meeting. If the board decides they want to adopt it, they can do so by a majority if they have an in-person meeting, or unanimous if it's by written consent action. That's the instance where there's not an in-person meeting, but the materials are circulated amongst the board members, and they can unanimously in writing vote in favor of or against a proposal. Once the board has adopted the change, then it is then submitted to the shareholders for their approval. This is one of the areas in which shareholders typically will have a vote when there's any amendment to the Articles of Incorporation. Under the MBCA, the view is that it has to be a plurality of the quorum. That means more people have to vote for than against it that are actually present and represent a majority of the shares that are entitled to cast votes on the amendments. Under Florida law and other states, it's a simple majority vote of the quorum, a majority vote of those that are entitled to be cast. In some states, they require a supermajority, 2/3 of the votes entitled to be cast. And that, of course, is not in Florida, but in other states. So keep in mind that the voting process can be different depending on state statute. So take a look at the state statute to determine which would apply. Once the amendment is made, then of course you must file articles of amendment with the Secretary of State's office. And as we know, whenever we involve the Secretary of State, there usually is a filing fee. Keep in mind that there are times that if you've had articles of incorporation that you have amended a number of times, it can be difficult to determine in one document what are the current articles of incorporation. So in most states, you are allowed to do what's called restate your articles of incorporation. You are not amending or changing them. You are basically taking all of the approved amendments and then restating it in one clean document that contains all of those amendments, so that parties don't have to shift between various documents in order to determine what is under the articles of incorporation. Aside from amending the articles of incorporation, once a corporation is in place, it may be determined that it makes sense to also amend the corporate bylaws, which spell out the various processes that must be followed by the corporation. Some of the common reasons that you might find for amending the bylaws are to change when the annual meeting is, to change or update the duties of the corporate officers, to add language about officers or directors, or to change voting processes. Typically, amending the bylaws can occur by a vote of the Board of Directors. That vote by the Board of Directors only requires a majority vote. But it will depend on the nature of the bylaws. In some bylaws, any changes to the corporate bylaws must also be approved by the shareholders. If shareholder approval is required for any Board of Director action regarding amending the corporate bylaws, then similar to the Board of Directors, it's a simple majority of the votes entitled to be cast. So if you have a quorum, a simple majority of the quorum will be sufficient to amend the corporate bylaws. We know from our discussion of other business entities, dissolutions of those business entities can be both voluntary and involuntary. In the environment of the corporation, there are a variety of different ways that there can be voluntary dissolution of the corporation. If there has not yet been an issuance of stock, then the promoters and board of directors in place, by a majority vote, can voluntarily dissolve the corporation. Another way is if there is already stock that has been issued, then the board of directors, by majority vote, can dissolve the corporation, if it's an in-person director meeting. If it is something that is done by written consent action, that is, that a written proposal is circulated amongst the board of directors, then the vote must be unanimous and in writing. If the board determines that either by majority vote for in-person or unanimous vote when it's a written consent action, then typically it must be followed by notice to the shareholders, and the shareholders must vote to approve the Board of Directors' resolution to dissolve the corporation. Similar to our prior discussions, a majority of votes cast by those who are entitled to vote, if a quorum exists, will be sufficient to dissolve the corporation. So again, a majority of the votes of the quorum will be enough to uphold, by the shareholders' vote, the Board of Directors' resolution to dissolve the corporation. However, if the shareholders decide that they wish to initiate a dissolution action, then they will need a unanimous vote of an in-person shareholder meeting, either at the annual meeting or a special meeting. or they can do it in a written consent action. Either way, it has to be unanimous if it comes from the shareholders. If there is a determination, either by the promoters, the board, or the shareholders, that the corporation will be dissolved, then there's a filing of the Articles of Dissolution with the Secretary of State's office. And don't forget that friendly filing fee. At that time, the Secretary of State will determine whether or not the corporation has paid all of its taxes. If it has paid all of its taxes, then the corporation will receive a tax clearance form. And at that point, they can initiate the liquidation process. But keep in mind, if taxes are still due, the Secretary of State will not yet approve of dissolution until they have carried out their tax obligations. As with other business entities, there can also be involuntary forms of dissolution. Judicial dissolution can come about in a variety of ways. The state, such as the Secretary of State's office, can be the petitioner. They can request that the courts dissolve a corporation based on claims of fraud or abuse of corporate authority. Shareholders of a close corporation can also petition a court for a judicial dissolution. Think back to our earlier discussion of the closely held corporation. If there has been oppression, fraudulent, or illegal conduct, then shareholders of a close corporation can seek the assistance of the courts to dissolve the organization. And then a creditor may also be a petitioner. It could be an instance in which a debt is owed and they are going to court because the corporation is now insolvent, or the corporation has acknowledged the debt but is unwilling to dissolve itself and to liquidate in order to pay off its creditors. This is another basis for the courts to act. With judicial dissolution, there is no opportunity for reinstatement of the corporation. If it was a voluntary dissolution, that is, by the promoters, the board, or the shareholders, there is the opportunity to revoke the dissolution within 120 days. But if it has been a judicial dissolution, there is no opportunity for reinstatement. We also know that there can be administrative dissolutions. This, of course, primarily would come from the Secretary of State's office or whatever the governing agency is in a given state for corporations. Typically, if one has an administrative dissolution, it may mean that one has failed to file their annual reports, have failed to pay their applicable fees or taxes, have failed to have a registered agent or registered office in the state, have failed to notify the state of changes in their registered agent or office, or are continuing to operate outside of the corporation's duration under the Articles of Incorporation. So if the corporation, say, was only supposed to be in place for 2 or 3 years and that time period has ended and they're continuing to operate, that may also provide a basis for an administrative dissolution. In the case of an administrative dissolution, there's always the opportunity to cure the defaults. So if you didn't file the annual report, you could file it. If you didn't pay the taxes, you could pay the back taxes. If you didn't have a registered agent or you changed it, you could properly update your paperwork to notify the state of your registered agent or your registered office. Unlike judicial dissolution, there is the opportunity to seek reinstatement. Under the MBCA, you can reinstate up to 2 years after an administrative dissolution. In Florida, we're much more generous. At any time, one can cure their defaults and seek reinstatement of an administrative dissolution. But keep in mind, if you seek to reinstate and another corporation is now using that earlier corporate name, you don't have rights to it. They may continue to use that name and you may have to come up with another name. So keep in mind, voluntary dissolution, you have up to 120 days to revoke. Judicial dissolution, there is no reinstatement. Administrative dissolution, if you cure your defaults, you can seek reinstatement. Up to 2 years under the model code, and in Florida anytime after the administrative dissolution. Once the corporation is dissolved, now it's time to turn to the final step, the liquidation of the corporation. Once dissolution has occurred, the corporation has no authority to conduct any other business outside of the liquidation process. If it's a voluntary liquidation, that is, it's a voluntary dissolution followed by a voluntary liquidation, then there are no set time limits. But generally speaking, if the corporation has been dissolved, the board will act quickly to try to finalize any of the activities needed to liquidate the corporation. If it's a judicial liquidation, then a court might appoint a receiver, that is, a third party, to oversee the liquidation process and may determine the timetables for liquidating the corporation. The basics of the liquidation process, of course, is to collect up all of the assets, to dispose of any properties that will not be distributed to the shareholders, to discharge any liabilities or make provisions for discharging liabilities, for both known claims and unknown claims. For known claims, the Model Business Code provides an orderly process for disposing of claims against the corporation. For these known claims, the corporation must notify the claimants in writing of the dissolution, inform the creditor or claimant where to submit their claim, and provide at least 120 days for the creditor to make the claim, and inform the creditor that the claim will be barred if not timely submitted to the corporation. So the claimant, once they've received that notice, typically they have at least 120 days, and if they do not file their claim in a timely manner, it may be barred. So if they don't submit it in a timely manner, they lose out on the opportunity to collect on the debt. If the claim is submitted and the corporation rejects it, then the claimant must institute a legal action within 90 days of the rejected claim in order to enforce the claim, or it will be barred. As regards unknown claims, to ensure that unknown claims are also discharged, the code provides that the corporation may place in the newspaper of general circulation a notice of dissolution, stating that the claim will be barred unless an action to enforce the claim is brought within 3 years of the published notice. In some states, the notice must also be published on the corporation's website. So unknown claims may be those who are not necessarily creditors, but those who might claim that they were harmed by the corporation, or through tort actions, or were wrongfully discharged as employees, or the like. So with these unknown claims, it's very important that notice be made so that those who do have claims can recognize that the corporation is being dissolved and act within a timely fashion, 3 years of the published notice, to bring their claims. Now, the important thing to keep in mind is that what happens to if someone does have a claim. How are they going to get money from a corporation that has been dissolved? Well, in many instances, the way to do this is that a corporation can set aside funds for unknown claims, and they could do it perhaps based on what their claim history has been in the past. In other cases, they may have insurance. And that insurance is put into place in case a claim comes up that they were not anticipating. So that the insurance company, in essence, would be taking care of the claim later on down the line. If the corporation's assets have been distributed before the claim is made, and there's either not enough of it set aside or not enough in insurance, the shareholders may still be liable. They will not be personally liable. They will only be liable to the extent of the assets that were distributed to them during the liquidation process. So if you have the situation in which there is a claim that comes up, and there's either no insurance or no insurance left, or there's no set-aside money left, then a party might still come after the shareholders to try to claw back any of the assets that were distributed to them. Once there has been appropriate processes put in place for both known claims and unknown claims, then there's a distribution of any of the remaining assets to the shareholders according to their respective interest. In many cases, there may be nothing to distribute to the shareholders. But if there are, then you must look at the residual claims and make a determination about were there preferred stockholders who had a preference, that is, a preference in the liquidation process over common shareholders. If there was this preference in place for preferred stockholders, then they must be paid first from any remaining assets, and then the common shareholders are last in line.
Thank you for watching this final review makeup podcast. To receive attendance credit for our canceled class of November 13th, 2019, you must do the following. Send me an email, lucille.ponte@famu.edu, stating that you watched the final review makeup podcast and what date you watched it. Provide me with the password for this podcast in that email. The password is Final Review. And then email me on or before midnight on Wednesday, November 27th, 2019. Please be certain to send me a professional email with full sentences, including both a greeting and a sign-off with your signature on it, your electronic signature, so I know exactly who is sending it to me and maintaining the professionalism of our email contacts. All right, so remember to do this. Send me the email at my address. Tell me what date you watched it. Provide me with the password for this podcast, which is Final Review. And then make sure you email me on or before midnight on Wednesday, November 27, 2019. Thank you, and good luck on all of your final exams.